Artificial intelligence is attracting the largest infrastructure investment wave in modern history, yet 95% of organizations investing in AI report zero measurable return. Both of those realities cannot coexist for very long. This discussion is for educational and analytical purposes only and does not constitute financial advice. The scale of this contradiction extends far beyond typical technology investment cycles. Amazon, Google, Meta, and Microsoft collectively plan to deploy approximately $400 billion on AI infrastructure this year alone. These are not speculative startups burning venture capital on unproven concepts. These are the most profitable corporations in human history, companies that generate hundreds of billions in annual cash flow, committing roughly 50% of their current cash generation to data center construction and AI development. Yet research from MIT reveals that despite $30 to $40 billion in enterprise AI investment, the overwhelming majority of implementations produce no detectable impact on organizational performance or profitability. The firms building the infrastructure are profitable. The firms buying the infrastructure are not seeing returns. This creates a structural tension that markets have not yet reconciled. The magnitude becomes clearer when viewed through historical context. Morgan Stanley analysts project that big tech companies will spend approximately $3 trillion on AI infrastructure through 2028. For perspective, this represents more nominal spending than the Apollo program that delivered humans to the moon, except compressed into a fraction of the time frame. The Apollo program allocated roughly $300 billion inflation-adjusted dollars over a decade. The AI build-out requires equivalent investment not every 10 years, but every 10 months. What makes this particularly significant is not the size of the investment, but the financing structure supporting it. Current cash flows from these technology companies can cover only half of projected spending requirements. The remainder must come from debt financing, equity raises, or reduced returns to shareholders. This creates a dependency chain where continued investment relies on sustained confidence in future returns that have not yet materialized in measurable form. The concentration of this investment creates additional structural risks that markets typically price gradually rather than immediately. By late 2025, 30% of the S&P 500 and 20% of the MSCI World Index consisted of just 5 companies. This represents the highest market concentration in 50 years. The performance of AI-related investments now drives broader market outcomes to a degree that exceeds previous technology cycles, including the dot-com boom. And the reason this hasn't been reflected in price yet is not what most people assume. The visible narrative supporting current valuations follows a logical progression that makes intuitive sense to most market participants. OpenAI released ChatGPT in November 2022, achieving 100 million users faster than any application in history. The demonstration of large language model capabilities triggered recognition across industries that artificial intelligence had reached a practical threshold for commercial deployment. This recognition phase drove immediate competitive responses. Google accelerated the release of previously internal AI systems. Microsoft committed $10 billion to OpenAI with additional funding commitments. Meta redirected substantial resources toward AI research and infrastructure. Amazon launched competing services and partnerships. The technology giants recognized that missing this transition could mean losing competitive position permanently. The investment logic appeared straightforward. Companies that controlled the infrastructure layer would capture the majority of value creation as AI capabilities expanded across industries. Data centers, specialized computing chips, and cloud services represented the foundational layer that all AI applications would require. Controlling this layer meant capturing revenue regardless of which specific AI application succeeded commercially. Nvidia emerged as the primary beneficiary of this infrastructure demand. The company's graphics processing units proved ideal for the parallel computing requirements of AI training and inference. Revenue from data center sales grew 427% year over year as organizations competed to secure chip allocation. Nvidia's market capitalization increased proportionally, making it one of the most valuable companies globally. The revenue growth appeared to validate the investment thesis. Cloud providers reported that spending $1 on Nvidia hardware could generate $5 in rental revenue over 4 years. Newer hardware configurations promised even stronger returns, with some arrangements projecting $7 in revenue for each dollar of hardware investment. These metrics suggested sustainable unit economics supporting continued infrastructure expansion. If you're interested in understanding markets beyond headlines, this channel focuses on exactly that. Enterprise adoption provided additional validation signals. Organizations across industries began implementing AI capabilities for customer service, content generation, data analysis, and operational optimization. The breadth of potential applications suggested that demand for AI infrastructure would expand rather than plateau as the technology matured. Financial markets responded to these signals with sustained capital allocation toward AI-related investments. Venture capital flowed toward AI startups at unprecedented rates. Public market valuations increased for companies with credible AI strategies or infrastructure positions. The feedback loop between investment, capability development, and market recognition created momentum that reinforced itself across multiple cycles. The timeline supported confidence in the investment narrative. Unlike previous technology transitions that required decades to demonstrate commercial viability, AI applications showed immediate utility for specific use cases. Organizations could implement chatbots, automate routine processes, or enhance existing software with AI features relatively quickly. The speed of deployment suggested faster returns on infrastructure investment compared to historical technology cycles. This is the part most people understand. The part that actually changes the outcome comes next. On the surface, everything still appeared to make sense. Infrastructure spending generated measurable revenue for suppliers. Cloud providers secured long-term contracts with predictable cash flows. Technology companies expanded market share in what appeared to be a rapidly growing sector. The visible metrics supported continued investment at current scales. The hidden structure reveals different dynamics that contradict the surface-level narrative. While infrastructure suppliers report record revenue growth, the organizations purchasing this infrastructure face a more complex reality. The MIT research indicating zero return for 95% of AI implementations represents systematic rather than isolated outcomes. The cost structure of AI deployment creates inherent challenges that infrastructure metrics do not capture. Training sophisticated AI models requires substantial computing resources, but the expense occurs up front while benefits materialize gradually over extended periods. Organizations must commit significant capital before knowing whether their specific implementation will generate positive returns. More fundamentally, the circular financing arrangements between major technology companies create artificial demand signals that may not reflect genuine market dynamics. Nvidia invests $100 billion in OpenAI to fund data center construction. OpenAI commits to purchasing millions of Nvidia chips for those facilities. Oracle signs $300 billion in cloud infrastructure agreements with OpenAI, then uses that revenue commitment to purchase Nvidia hardware for data center construction. These arrangements create revenue recognition for all participants, while the actual cash flows in predetermined circles. Nvidia records sales to Oracle and direct investment recovery from OpenAI. Oracle records contracted revenue from OpenAI and uses OpenAI's payment commitments to finance Nvidia purchases. OpenAI secures infrastructure capacity funded by Nvidia's investment, which enables fulfilling Oracle contracts that justify Nvidia's investment. The interdependency means that financial stress at any single participant could cascade through the entire network. If OpenAI cannot fulfill its Oracle commitments, Oracle faces potential losses on infrastructure investments made specifically to serve those contracts. If Oracle reduces Nvidia purchases due to capacity oversupply, Nvidia's revenue growth slows, potentially affecting its ability to continue funding OpenAI expansion. The concentration of relationships amplifies these risks. A relatively small number of companies control the majority of AI infrastructure investment, chip production, and cloud services. Market dynamics depend on continued coordination between these participants, rather than competitive market forces that typically drive pricing efficiency. Physical constraints add additional pressure that financial arrangements cannot resolve indefinitely. Semiconductor production capacity limits the rate at which AI infrastructure can expand. Data center construction requires substantial lead times and specialized components. Power grid capacity in many regions cannot support planned data center expansion without significant utility infrastructure investment. These constraints mean that current spending commitments may face fulfillment challenges regardless of financial capacity. Organizations may secure funding for AI infrastructure expansion, while facing delays in actual deployment due to supply chain limitations or regulatory approval processes for power and facility expansion. This is where the same forces that drove growth begin to reverse. The production capacity bottlenecks create timing pressures that compound the financial misalignments. TSMC, the primary manufacturer of advanced semiconductors, operates near full capacity while demand for AI chips continues expanding exponentially. The company projects lead times extending 12 to 18 months for new orders, meaning organizations committing to AI infrastructure today cannot actually deploy that infrastructure until well into 2026 or beyond. This delay structure forces companies into a peculiar position. They must maintain financial commitments to secure future chip allocation, while generating returns from existing infrastructure to justify continued spending. Organizations find themselves paying for computing power they cannot yet access, while trying to monetize computing power that may already be insufficient for competitive positioning. The power grid constraints introduce additional complexity that financial planning cannot resolve through increased spending. Data centers require consistent electrical supply that often exceeds the capacity of local utility infrastructure. Proposed AI data center construction in many regions would consume more electricity than entire metropolitan areas currently use. Utility companies face their own capital allocation challenges. Upgrading power transmission and generation capacity to support planned data center expansion requires infrastructure investment with longer payback periods than the AI companies can guarantee. The mismatch between utility infrastructure timelines and AI deployment schedules creates dependencies that neither sector fully controls. Oracle's situation exemplifies how these constraints interact with financial commitments. The company committed $300 billion to provide cloud infrastructure to OpenAI over 5 years. Meeting this commitment requires constructing data centers that depend on chip allocation. Oracle cannot guarantee and power capacity that may not exist in desired locations. The company reports losses of $100 million in recent quarters, specifically from data center operations, primarily serving OpenAI requirements. The geographic distribution of these constraints varies significantly, creating additional optimization challenges. Regions with available power capacity often lack fiber optic infrastructure necessary for low-latency AI applications. Areas with strong telecommunications infrastructure face power grid limitations. Locations with both power and connectivity often have regulatory environments that slow construction approval processes. These physical realities force infrastructure providers into suboptimal compromises that increase operational costs beyond initial projections. Companies may build data centers in locations that require expensive power purchases or accept higher latency connections that reduce the commercial viability of certain AI applications. The semiconductor supply constraints create particularly acute pressure because they affect the entire industry simultaneously. Unlike previous technology transitions where companies could adjust timing or specifications to manage supply challenges, AI infrastructure requires specific chip architectures that have limited substitution possibilities. Organizations cannot easily switch between suppliers or modify requirements to accommodate supply limitations. TSMC's production allocation decisions therefore influence the competitive dynamics of the entire AI sector. Companies that secured early chip allocation maintain operational advantages regardless of their financial resources or technical capabilities. Organizations with superior funding but later supply commitments face delayed deployment that could affect their market position. The concentration of chip production at a single facility creates systemic vulnerability that extends beyond normal supply chain risks. Any disruption to TSMC operations would affect multiple AI infrastructure providers simultaneously, potentially forcing widespread project delays across the industry. Meanwhile, the demand signals that drive continued investment may not reflect actual market dynamics. Enterprise surveys consistently show that organizations plan to increase AI spending significantly over the next several years. However, the same surveys reveal that current implementations rarely meet expected performance targets or generate measurable productivity improvements. This creates a feedback loop where projected demand justifies continued infrastructure investment, while actual utilization remains below capacity in many cases. Cloud providers report strong booking numbers for future AI services, while acknowledging that current usage patterns suggest organizations are purchasing more capacity than they actively deploy. The pricing dynamics reflect this mismatch between committed spending and actual utilization. Cloud providers offer significant discounts for long-term AI infrastructure commitments while maintaining higher prices for on-demand usage. This pricing structure encourages organizations to commit to future spending based on projected needs rather than demonstrated requirements. The resulting utilization patterns show substantial variation between organizations and use cases. Some companies achieve high utilization rates for specific AI applications, while maintaining unused capacity for experimental projects that never reach production deployment. The aggregate utilization across all committed infrastructure remains significantly below the levels needed to justify current expansion rates. Financial reporting practices further obscure the true economics of AI infrastructure investment. Companies typically report infrastructure commitments as contracted revenue, while the actual cash flows depend on usage patterns that may develop differently than projected. Revenue recognition rules allow booking future commitments immediately, while the costs of unused capacity accumulate over time. The accounting treatment creates temporary financial advantages for infrastructure providers that may reverse if utilization patterns fail to match committed spending levels. Organizations may find themselves paying for contracted capacity while seeking additional providers for actual workloads if their requirements evolve differently than originally projected. The talent constraints add another dimension that financial resources cannot immediately resolve. AI infrastructure requires specialized technical expertise for deployment, optimization, and maintenance. The shortage of qualified personnel limits how quickly organizations can effectively utilize purchased infrastructure capacity. Universities and training programs cannot increase the supply of AI specialists fast enough to match infrastructure expansion timelines. Companies compete for limited talent pools while simultaneously investing in infrastructure that requires expertise they may not be able to hire. The talent bottleneck means that infrastructure utilization may remain below capacity even when technical resources are available. These converging constraints create pressure points where continued investment becomes increasingly difficult to justify through traditional financial metrics. Organizations must maintain spending commitments to preserve competitive positioning while facing growing uncertainty about when those investments will generate measurable returns. The system doesn't fail here, it tightens. The financial stress appears first in utilization patterns that contradict public reporting. While infrastructure providers announce record-breaking contract values, the organizations paying for this capacity face a different reality. Enterprise AI implementations require substantial upfront investment, with benefits that materialize slowly and unpredictably across extended deployment periods. The cost structure creates immediate pressure on technology budgets, while returns remain theoretical for most organizations. Companies must allocate significant resources to AI infrastructure before understanding whether their specific use cases will generate measurable improvements in productivity or profitability. This timing mismatch forces organizations to maintain spending commitments based on projected benefits rather than demonstrated results. The talent shortage compounds these financial pressures in ways that infrastructure investment cannot resolve. Organizations purchase computing capacity that requires specialized expertise they cannot hire quickly enough to utilize effectively. The shortage of qualified AI specialists means that expensive infrastructure often operates below capacity, while companies compete for limited talent pools to manage systems they have already purchased. Geographic constraints introduce additional costs that initial infrastructure planning frequently underestimates. Data centers require proximity to both reliable power supply and low-latency network connections. Many locations with adequate electrical capacity lack the fiber optic infrastructure necessary for optimal AI performance. Areas with strong telecommunications networks often face power grid limitations that require expensive utility upgrades or premium electricity purchases. The semiconductor allocation system creates artificial scarcity that drives purchasing decisions independently of actual deployment capacity. Organizations commit to future chip orders based on projected requirements, rather than current utilization patterns. The extended lead times force companies into speculative purchasing, while they simultaneously try to optimize existing infrastructure that may already exceed their immediate processing needs. These converging pressures manifest differently across organizations but follow consistent patterns. Companies with substantial financial resources can maintain infrastructure commitments longer while searching for productive applications. Smaller organizations face earlier pressure to demonstrate returns from AI investments or reduce future spending commitments. The accounting treatment of infrastructure contracts allows companies to defer recognition of these pressures while maintaining growth narratives. Organizations typically report AI infrastructure spending as strategic investment rather than operational expense. This classification permits continued spending even when short-term utilization metrics suggest overcapacity relative to productive applications. The vendor financing arrangements further obscure the true cost of AI infrastructure deployment. Cloud providers offer deferred payment terms and usage-based billing that allows organizations to avoid immediate cash flow impact from capacity commitments. These financing structures enable continued infrastructure expansion, while actual utilization patterns develop more slowly than projected. The feedback mechanisms between infrastructure providers and enterprise customers create additional complexity in assessing genuine demand signals. Vendors typically offer substantial discounts for long-term commitments while maintaining higher pricing for flexible or on-demand usage. This pricing structure encourages organizations to commit to future capacity requirements based on optimistic utilization projections. Enterprise surveys consistently indicate plans for increased AI spending, while simultaneously revealing that current implementations rarely achieve expected performance targets. This disconnect suggests that projected demand may reflect aspirational planning rather than demonstrated business cases for expanded AI deployment. The competitive dynamics force organizations to maintain AI infrastructure investment regardless of immediate returns. Companies risk losing market position if competitors achieve breakthrough applications while they reduce technology spending. This defensive positioning drives continued investment even when internal metrics suggest suboptimal resource allocation. The regulatory environment adds uncertainty that complicates long-term infrastructure planning. Proposed legislation regarding AI development, data usage, and algorithmic accountability could affect the commercial viability of current infrastructure investments. Organizations must balance current spending commitments against potential compliance costs that remain undefined. The international competitive pressures create additional incentives for sustained infrastructure investment despite unclear returns. The emergence of capable AI systems from international competitors demonstrates that technological leadership requires continued resource allocation. Organizations cannot easily distinguish between necessary competitive investment and speculative overallocation. The mispricing persists because the visible metrics still support the growth narrative. Infrastructure providers report record revenue. Technology companies announce expanded partnerships. Enterprise surveys indicate continued spending plans. These signals maintain confidence, while the underlying constraints accumulate pressure that financial reporting does not capture. The system maintains stability through financing structures that defer immediate cost recognition. Organizations can commit to future infrastructure spending without immediate cash flow impact. Vendor financing and usage-based billing allow continued expansion, while utilization patterns develop more slowly than projected. The accounting treatment permits strategic classification of AI spending that avoids operational expense recognition. Market concentration amplifies this dynamic. The same companies driving infrastructure investment also control the metrics that validate continued spending. When Nvidia invests in OpenAI, which commits to Oracle contracts, which require Nvidia hardware purchases, the circular revenue recognition maintains growth signals across all participants simultaneously. The competitive pressures prevent individual organizations from reducing infrastructure commitments even when internal metrics suggest suboptimal returns. Companies cannot distinguish between necessary competitive investment and speculative overallocation. The defensive positioning drives continued spending regardless of demonstrated business cases for expanded AI deployment. Physical constraints will eventually force recognition of these misalignments. Semiconductor production capacity, power grid limitations, and talent shortages create bottlenecks that financing arrangements cannot resolve. The timing mismatches between infrastructure commitments and deployment capabilities will manifest in utilization patterns that contradict contracted spending levels. What would force market reassessment remains structural rather than cyclical. Extended deployment delays due to supply constraints. Sustained enterprise reporting of zero returns on AI investment. Utility infrastructure limitations that prevent promised data center construction. Any combination of these factors could trigger recognition that current valuations assume infrastructure utilization that physical realities cannot support. The gap between committed infrastructure spending and demonstrated returns represents systematic mispricing across multiple sectors. organizations continue investing in AI capabilities, while the overwhelming majority report no measurable impact on performance or profitability. This contradiction defines the most significant disconnect between investment and outcomes in modern markets. This is what remains unpriced for now,